It's just a few minutes left in the trading day, about 9 to be precise. It's time for the big picture. Let's welcome in Cooper Howard, Director and Fixed Income Strategist at Schwab Center for Financial Research. Cooper, thanks so much for joining us.
Thank you for having me, Carolyn.
All right, so Cooper, we've seen some monster moves in bonds. It's a technical term. Can you help us make sense of the action we've been seeing?
Yeah, we have seen some monster moves in bonds, and obviously a lot is related to the trade volatility and what's going forward with tariffs. We saw just last week that was the implementation of tariffs, and since then we've seen quite a bit of volatility. In terms of where yields are right now, they've continued to move up. We've seen that more on the longer term of the yield curve. So to me, there might be some deleveraging trade going on in terms of kind of people trying to liquidate some positions to sell off some things. I think it's a difficult market, Caroline, to really navigate through and to make a analysis of exactly what is happening, because there is a lot of narratives happening. It is very much headline driven, but I think what's important, especially from an investor standpoint, is to take a step back. And what we try to do is help calm the nerves and kind of help them understand, control what you can control. So in terms of what to do in this market, Caroline, really what our team has been suggesting is focus a little bit more on a cautious position. Focus on higher rated issuers, focus on a benchmark duration. We think given all of the volatility, given the headline risks that are out there right now, makes sense to take a little bit cautious of approach.
When you say, higher benchmark duration, how high are you talking about? What sort of duration are you talking about?
Yeah, and I want to clarify, not a higher benchmark duration. We think stick with a benchmark duration.
Okay.
So when we're looking at a higher rated, yes. Yes. So higher rated benchmark duration, two kind of separate things, if you will. But when we're looking at a benchmark duration, because I think that this is a very important point, we're looking at the Bloomberg US Aggregate Bond Index. That has a duration of about 6 years. So we think that's probably a pretty good starting point. That doesn't mean just focus all on 6-year bonds. Spread out across the yield curve. Have some shorter term bonds, have some longer term bonds. If we potentially start to see yields move up even more from where they are right now, we'd get a little bit more attractive in terms of adding to duration. So that's on the duration side of things, but that's a benchmark duration. The other side of things is where to focus on credit quality. We think it makes sense to focus on higher rated issuers, Caroline. That's going to be issuers like investment grade corporate bonds, investment grade municipal bonds. Right now, if we are facing a slowdown in the economy, and there's no doubt that the odds of a recession have increased, a lot of strategists have increased their probabilities recently of a recession. Those issuers with larger liquidity balances, less volatile revenue sources, they should be able to weather through that storm a little bit better than those that are lower rated.
Yeah, I'm curious about what you think in terms of the recession forecast, Cooper, because we did see Goldman Sachs rescind that recession forecast. I think they were at like 65%. They rescinded it back to 45% because of the tariff developments. We'll hear from Jamie Dimon, of course, tomorrow. He's always has, pretty insightful economic commentary. I'm pretty sure JP Morgan was at something like 60%, said it's probably likely because of tariffs, but then there's been some developments. Obviously, we did get inflation data today that's, that was better than expected, and some Fed commentary that seems like the Fed's not going to really step in at all, at least in the nearer term. So do you think that we should be thinking about a recession right now?
Our team doesn't come out with a formal probability of a recession or kind of here are the odds of a recession or a formal call on a recession. But I do think that the odds of an economic slowdown definitely have increased recently. And a lot of kind of what you mentioned, I think, is a very good starting point to unpack. We saw the CPI numbers today. They were better than expected, but that's largely backwards looking. Going forward, really what's going to be the big driver is what happens with the tariff policy. How big are the tariffs and how long ultimately are they implemented? If you asked me this morning, I would have said that it was 125% on China. Ask me this afternoon and we're seeing 145% on China. So you mentioned earlier in your opening statements that we only have 9 minutes left to go in the market. 9 minutes can be a lot in this market. So we're seeing things shift every minute and a lot is being driven by headline risk. I think that gets to the point about Excuse me there.
No, go ahead. That gets to the point about.
I was going to say that gets to the point about the Fed and ultimately what are they going to do? And what we're anticipating is they're going to take a little bit more of a cautious approach. We heard from Chairman Powell last week that they want to be patient. Other Fed officials have really reiterated that point. Seems like they're preaching from the same playbook, is that they want to look, see what happens with the economy, what happens with the employment numbers, inflation numbers, what happens ultimately with the tariffs, and then begin to react from there. They're looking at the same data that we're looking at, Tom. They're probably piecing it quite a bit though right now and trying to anticipate what's coming down the pipeline, but this is a market that's really being driven by headline risk.
Okay. All right. In terms of what this market, I was just trying to take a look at the CME Fed Watch tool, but I can't look through the rest of the year in that quick of time. Is the market coming around to maybe not seeing 5 rate cuts this year?
You know, right now, again, that's been bouncing around quite a bit because to your previous speaker's points, volatility has been the theme, and that's volatility in treasuries, volatility in munis, volatility in terms of expectations for what the Fed is going to do. That's been about 4 rate cuts is where the CME watch tool is coming in right now. Our expectation is unless there's a significant sell-off unless there's a significant deterioration in the economy, probably think 4 right now is pretty aggressive.
Okay. All right. Yeah, I was just taking a look. So 4, we'll see. But we've seen the expectation shift so much over the past couple of years, so we know that can change as well. Cooper Howard, Director of Fixed Income Strategist, Schwab Center for Financial Research.